What if the numbers don't add up? Obviously some of the numbers will add up, but do you know that every reconciliation will work out, every control will be accurate? Also, what if the story that the numbers tell isn't one that shows your business in a favorable light? When would you want to know about the problems? I'm Brian Birch, I'm an insurance finance consultant, and if you like this video, please comment below and link on LinkedIn. IFRS 17 was proposed and now we have some amendments. You may be preparing your project or be underway dealing with data, with processes, different projects or work streams, people, stakeholders. You may have some simple reports. You may expect to monitor cash, profits, asset liabilities, and control totals. In the general model, for instance, the insurance contract liability can be broken down into two ways: the liability for remaining coverage, the loss component, the liability for incurred claims, but also it can be broken down into the future cash flows, the risk adjustment, and the contractual service margin. Now, you may need to break numbers down in several ways, and some numbers will be split. Let's consider some of the reconciliations, complexity, and the scenarios. With the CFO, the auditor, and the stakeholders' scrutiny, what's needed is reporting that deals with an extraordinary level of persistence and attention to detail. The disclosures require several items to be split, such as assets from liabilities, such as reinsurance from gross figures. For disclosures, for narrative, and for business performance, you'll need quite a range of numbers. You'll need to be able to break them down into splits, allocate things into line items, put them into the right period, as well as the business unit and geography. There's a lot of complexity at getting this right at both the top level and all of the levels of detail and types of detail that you need. It's an easy mistake to make, to deal with the top level numbers and not deal with all of the processes and splits that you need for IFRS 17. Sometimes I see a number showing the liability for remaining coverage, but not splitting the total number into future cash flows and risk adjustment as well. Has part of the reconciliation been lost, or what's going on? If you are dealing with numbers, if you're checking things, if you're testing things, or just going through business scenarios to understand how you can explain your business, you need to look at the reports and have reports that make sense. You may need to make several changes to data, assumptions, scenarios, use cases, etc., and concurrent changes, and then see the report for that. So it could be very useful to have a single report showing all of the aspects. The single report could deal with multiple measurement models if some numbers are blank for some of them. Some of the changes to the output reports could be unexpected. You may not expect inputs to have the exact outputs that they have, and the cause and effect is worth looking into. And again, a single output report makes this easier in the sense that you can see a total number, you can see breakdowns, you can see that the numbers are accurate. The effects of reinsurance may be odd. Some of this is down to the nature of how the standard deals with reinsurance. Now you may say the software will deal with the reports, and it may do. It will probably give you data, it may give you some reports, but some software vendors leave a lot of the reporting to the client, and a valid reason for this is the client may want to use their own reporting. However, you need to make sure that between you and the software vendor, you have all the reports that you need. If you've got problems with reports and you need to change it, it may add costs and time and to the overall project. Having dealt with the initial simple attempt at a project and realized all of the difficulties that the splits and the disclosures may cause, a way of dealing with that is to have a relatively simple, it is a complicated report, but a single page that shows the main numbers, main breakdowns, and some of the control totals. At least it gives a single place to look and a consistent place to look, a consistent framework to be able to compare one use case to another, compare before and after, etc. you can identify mistakes and gaps, and you can then make sure that you have a plan to fix those. So a tip is not to leave specifying the reports until late in the day. Get a main report early to be able to get the main outputs and the main controls. You can then test things as you go along by looking at this and making sure that any gaps are known gaps and that there aren't unexpected surprises. If you can see real data going through the reports, that's ideal. The reports can help you check that the right accounting controls are in place. Having reports early can help you understand your business and understand how to show your business under IFRS 17 in the best light. Are some products loss-making? Has profit gone down? What has happened over time? When you have a report, if you're putting in different scenarios and use cases, different dimensions or assumptions could be changed, and you'll have a consistent format to be able to view the outputs, whatever the period, the model, the assumptions, the policies, or the product range. There's a simplicity of process in that you design one report and you have a consistent way of doing it, and if there are any fundamental changes, you change that one report. You don't have to change many reports. So the overall idea here has been to have a single report where you have a consistent way of looking at your business as you build up your project, as you begin to have the right data in real time to be able to report and understand your business, and that you can see the results, and also you can see the reconciliations and controls, and that the numbers are right. I'm Brian Birch. I'm an insurance finance consultant, and if you like this video, please comment below and link on LinkedIn. Best of luck with your project.